Well, there's been a lot of talk lately about silver ripping higher, stocks pushing into record territory, and precious metals suddenly becoming the market everyone wants to talk about. So, in this video, we're going to separate excitement from reality, and you are going to walk away feeling a lot smarter, a lot steadier, and a lot more prepared for what this move actually means. And today is Tuesday, May 12th, New York time. So drop a comment right now and tell me what day and what date you are watching from, because I like seeing how far this conversation travels. Also, quick thing before we dig in. If you value this work, support the channel by subscribing and commenting John AG Best. Now, in case you have not been watching silver closely, the move has been wild. We are not talking about a sleepy little uptick. We are talking about silver pushing back toward the low to mid-80s area after a powerful run that reminded everyone just how violent this market can get. And that is the first point I want to make. Silver is not gentle. Silver does not move like a normal asset when the crowd finally wakes up. It can sit there for months, frustrate everybody, shake out weak hands, and then suddenly move like somebody turned the lights on in a dark room. But here's the part people forget. The same volatility that feels amazing on the way up can feel brutal on the way down. So yes, enjoy the green, enjoy the breakout energy, enjoy the fact that silver is finally getting attention. But do not confuse a big move with a straight line. Those are not the same thing. Let me show you what I mean. A lot of people are trying to pin this rally on one thing. Some people say it is the gold to silver ratio. Some say it is inflation. Some say it is industrial demand. Some say it is tight supply. Some say it is investors looking at the stock market and realizing that almost everything already looks priced for perfection. And honestly, pieces of all of that can be true. That is what makes this moment interesting. It is not one spark. It is a pile of dry wood, and now the market is noticing the match. Based on recent market updates, silver has been gaining momentum while gold has been steadier, and that tells us something. Gold is still the big monetary asset, the asset institutions understand first. Silver usually comes later. It is smaller, faster, more emotional, and when capital rotates into it, the moves can look ridiculous before they make sense. But we need to be careful here. A rally does not automatically prove there is a crisis. A rally can mean physical demand is strong. It can mean traders are chasing momentum. It can mean short positions are uncomfortable. It can mean investors are finally repricing a neglected asset. Or, very often, it can mean all of those things are happening at the same time. So the question is not, is silver exciting today? Of course it is. The better question is, does the larger setup justify the attention? And that is where the story gets serious. According to the latest publicly available numbers, global silver mine production has only been improving slowly, while industrial demand has stayed extremely strong. In plain English, the world is asking more from silver than it used to, but the mining side is not suddenly flooding the market with new metal. That matters. Because silver is not just a shiny coin metal. It is not just something people stack in a safe and forget about. Silver sits inside the modern economy. Electrical systems need it. Electronics need it. Solar equipment needs it. Vehicles need it. Grid upgrades need it. Data centers, sensors, communications hardware, and AI infrastructure all sit on a physical foundation. And that foundation requires metals. People love to talk about the digital future like it floats in the cloud. It does not. The cloud has wires. The cloud has servers. The cloud has power demand. And somewhere underneath all that fancy technology, somebody had to mine the materials. Now here's where silver becomes different from a lot of other commodities. Higher prices do not instantly create higher supply. That sounds simple, but it is the piece most people miss. A lot of silver comes as a byproduct of other mining. So if silver jumps, that does not mean every mine in the world immediately becomes a silver machine. There is no magic lever. There is no emergency production button. There is no mine manager saying, silver is up today, double everything by Friday. Mining takes time. Permits take time. Capital takes time. Exploration takes time. Processing takes time. And if an industry spends years being ignored, it cannot rebuild itself in one earnings season. That is why the supply side is so important. Recent official mineral data shows the United States still depends heavily on foreign silver supply, while domestic silver comes from only a small number of primary silver mines and many byproduct operations. That tells you the system is not exactly overflowing with flexible supply. It is more like a machine that can work, but cannot sprint on command. Now, the demand side is not slowing down in the way people expected either. Yes, some categories soften when prices rise. Jewelry can cool. Silverware can cool. Some manufacturing can thrift, substitute, or reduce loadings. That is normal. But industrial demand has stayed near record territory, and the energy and technology build-out keeps pulling silver into the conversation. This is the tension. And this is where the mining equity angle starts to matter, even if you never buy a mining stock. The miners are the bridge between the story people tell and the metal the world actually receives. If capital refuses to fund exploration, future supply does not appear. If permitting remains difficult, future supply does not appear. If energy, labor, equipment, and financing costs rise, marginal projects get delayed and future supply does not appear. So when people ask why silver can move so sharply, part of the answer is that the market may be waking up to years of decisions that cannot be reversed quickly. That is not hype. That is how physical industries work. You can launch a software update overnight. You cannot launch a new mine overnight. You cannot replace skilled labor overnight. You cannot discover a deposit, permit it, finance it, build it, connect it to power and roads, and then ship metal because traders suddenly got excited on a Monday morning. The timeline is the message. And in silver, the timeline is slow, while the demand conversation is getting faster. Demand is becoming more strategic. Supply is still slow. And price is the thing in the middle trying to force an answer. But let us be balanced. I do not want to pretend every bullish point is perfect. Some people are acting like silver is guaranteed to explode every single week from here. That is not analysis. That is emotion in a silver costume. A strong long-term story does not protect you from a short-term shakeout. If silver runs too far too fast, traders take profits. Leveraged buyers get nervous. Algorithms react. Headlines change. And suddenly the same people screaming that silver can never go down are asking why the market is unfair. That is how this works. So if you are new, understand this clearly. A pullback would not automatically destroy the thesis. It may simply test whether people actually understand what they own. Now let us talk about inflation, because this is where the precious metals story becomes bigger than silver. The latest central bank language still points to inflation being above the long-run target, with energy and geopolitical uncertainty making the outlook more complicated. That is important, because markets have spent a long time hoping for easier policy. But if inflation stays sticky, the central bank cannot just hand everyone cheap money because traders want it. And this is where people get confused about gold and silver. They think metals need rate cuts. Not exactly. Metals respond to real conditions. If rates are high but inflation is still eating purchasing power, investors can still want hard assets. If the currency feels less stable, they can still want hard assets. If asset valuations look stretched, they can still want alternatives. So the important question is not simply, will rates fall? The important question is, after inflation, after risk, after uncertainty, does cash feel safe enough? And for a growing number of people, the answer is not as obvious as it used to be. Now compare that with the stock market. Stocks have been strong. Let us be fair. Recent earnings optimism and AI spending have pushed the major index to record levels, and some strategists are still lifting targets because corporate profits have held up. So this is not some simple story where stocks are dead and metals are the only game in town. That would be too easy. But strong is not the same as cheap. When the broad market is near record highs, especially when leadership is narrow and heavily tied to mega-cap technology, you have to ask what is already priced in. The central bank's own financial stability work has warned that equity valuations remain near the upper end of historical ranges, even as inflation and interest rate risks remain alive. That does not mean stocks crash tomorrow. It means the margin for disappointment is smaller, and that is exactly why silver is getting attention. Stocks are priced for excellence. Silver is being repriced from neglect. Those are two totally different starting points. Now, the gold to silver ratio adds another layer. When gold leads and silver lags, people eventually start asking whether silver is too cheap relative to gold. Ratios can stay stretched for a long time, so do not treat them like alarm clocks. But when the ratio starts compressing during a precious metals rally, silver can suddenly look like it is playing catch-up. And catch-up moves are not polite. They do not wait for everyone to feel comfortable. They move, pause, scare people, move again, and leave half the crowd arguing with the chart. That is why I want to separate the signal from the noise. The signal is that silver has a real supply-demand story, a real inflation connection, and a real role in industrial growth. The noise is the idea that every green candle proves some immediate end of the financial system. Be careful with that. You do not need a collapse story for silver to matter. You need a repricing story. And that repricing story is already enough. If you're successful, share your success story in the comments so others can stay motivated. Now, one more thing, the international angle. From recent market updates, silver pricing outside the United States has at times shown stronger pressure than Western traders expected. I would not build an entire thesis on one premium or one region, because local demand, currency moves, taxes, import rules, and delivery conditions can all affect price. But when overseas demand is firm at the same time, industrial demand is firm, and supply is slow, you pay attention. You do not panic. You pay attention. That is the mindset. That one discipline can keep excitement from turning into a very expensive mistake later for investors. The same thing is happening in gold in a different way. Big players are still treating physical gold as something worth owning, not just talking about. Digital gold products, vault accumulation, and institutional interest show that the hard asset story is evolving. It is not just old-fashioned coin buying. It is the modern financial system trying to wrap new technology around very old money. That is a fascinating signal. But again, do not overdo it. A signal is not a guarantee. It is a clue. So what happens next? In my opinion, the next phase comes down to three things. First, can silver hold momentum without turning into a disorderly speculative rush? Second, can industrial demand stay strong even if the economy slows? Third, can supply respond? Or does the market keep discovering that mining is slower than investor appetite? If the answer to those questions keeps favoring silver, then this move may have more room. Not in a straight line, not every day, not without drama, but structurally, the setup remains powerful. If the answers weaken, then silver can correct hard, and anyone who bought only because of excitement will learn a very expensive lesson. That is why discipline matters right now. Do not chase because somebody yelled a price target. Do not sell because one red candle scared you. Do not let social media turn your portfolio into a mood ring. Have a plan. Know your time horizon. Know whether you are trading, investing, stacking, or simply watching, because those are not the same thing. A trader needs exits. An investor needs a thesis. A stacker needs patience. And everybody needs humility. The market does not care how confident we sound on camera. It does not care how many people are celebrating. It does not care how badly we want a certain number. It moves when pressure builds, and then it tests the people who showed up late. So yes, silver is having a big moment. Yes, the stock market is making people rethink diversification. Yes, inflation is still part of the conversation. Yes, supply is not flexible. Yes, industrial demand is real. But the path will be messy. And honestly, that is fine. A messy bull market can still be a bull market. A scary pullback can still happen inside a larger uptrend. A strong thesis can still have painful chapters. The goal is not to feel excited every day. The goal is to understand why you are here before the market tries to shake you out. So watch the price, but do not worship it. Watch the data, but do not become blind to risk. Watch the crowd, but do not become the crowd. And if this kind of breakdown helps you stay clear-headed, subscribe and stay with me, because this silver story is getting more important, not less. I will leave you with this. The world is building more digital infrastructure, more power infrastructure, and more monetary uncertainty at the same time. That combination does not guarantee silver does anything on your schedule. But it does explain why a metal ignored for years can suddenly become impossible to ignore. This is for education and market discussion only. It is not personal financial advice, and I am not telling you to buy, sell, or hold anything. Your risk tolerance, cash needs, time horizon, and financial situation are yours. So think carefully before making any decision.